Hey everybody, Christopher here. I'm a certified financial planner professional and a wealth advisor at Centennial Advisors. It's no secret that the cost of education has absolutely skyrocketed in recent years. In fact, in-state tuition at a public college or university often costs between $10,000 to $15,000 per kid per year. Total all-in cost by the time you consider lodging, food, study abroad trips to Europe, and all of that good stuff, computers, is often about $30,000 per year per kid. So by the time you're all in, you're looking at close to $120,000 of higher education costs. No doubt about it that is a large sum of money, but don't get discouraged. If you're working with a clever planner, or if you are a clever planner, there are a lot of tax strategies that you can implement, as well as planning strategies and efficient giving strategies to help you get to this $120,000 or whatever mark it may be in the future efficiently and quickly and in a way that doesn't break the bank. The first thing I'll talk about is FAFSA eligibility, because it's one of the easiest things that you can do to really move the needle with regard to your education savings plan. Most people through FAFSA get about $5,000 to $10,000 per year, and remember that it is a needs-based grant program. Okay, needs-based meaning that people who have a greater financial need will receive more from FAFSA, and grant so you don't have to pay it back, which is great. Contrary to common belief, even though this is a needs-based program, high earners may still be eligible as long as they take some necessary precautions. One of the ways that this comes into play is in determining need for FAFSA, they take into account all of your assets, right? You have to make a list of everything that you own, your financial net worth, so to speak. And any assets that are titled in the name of the student count 4 times more in determining need than assets titled in the name of the parent. And that is not a good thing. That means that any assets in the student's name will reduce their eligibility by a factor that is 4 times greater than keeping assets in the parent's name. So a lot of the times, even though you want to gift kids money or stock or whatever for their education, a lot of the time it's better to just earmark an account in your name so that you don't risk their FAFSA eligibility. Next thing I'll talk about is 529 plans, which is a super common question that I get about education planning is, are 529 plans worth it? Now, this may come as a shock to you, but my answer is that it depends on your situation. 529 plans can be a killer tool. There are a lot of very special and honestly surprisingly good tax treatments and exemptions that 529 plans get that I'll talk about. But keep in mind that you want to be really careful about how you title the plan's assets. Typically, as long as it's allowed, the owner of the plan should be the parent. Because remember, if you title it in the name of the child, it'll count more towards discounting their eligibility, right? So you want to keep the parent as the owner and the child as the beneficiary. One of the nice things about 529 plans is if your first kid goes all the way through school and they don't use all of the plan assets, right, there's still money left over in there, you can redesignate a beneficiary. You can say, okay, sorry, kid number 1, kid number 2 is now the beneficiary of these assets. And then you can use those same plan assets for the next kid. And so you can kind of continue rolling it over to each kid if you've got more than one. And that's a nice trick that you can do. It's not really a trick, but you can do it with no adverse tax consequences, and you can do it as many times as you'd like. One of these crazy 529 plan rules that I alluded to is one called Superfunding. In any given tax year, there's an annual limit of how much you can gift another person before it becomes subject to gift tax. And in 2025, that limit is $19,000. Now, Superfunding allows you to put up to 5 years worth of gifts for that child, for that person, into a 529 plan all at once. This is the only account that I'm aware of that has this treatment that lets you do this. And I don't typically see parents doing this because usually by the time your kids are college age, you don't just have $95,000 lying around, but it's a really good strategy for grandparents. Now, you don't get a tax deduction upon contribution, right? When you put money in, there's no real tax benefit, but the money will grow tax deferred, right? If you reallocate your plan, sell some stuff, buy some stuff, you don't have to pay taxes at the time of sale. And as long as they're used for qualified purchases, you won't have to pay taxes on the withdrawals. Make sure to check out the description of this video for more information on what counts as a qualified withdrawal from a 529 plan. If you run out of kids to use 529 plan money for, if everybody's grown up, gone through school, paid for it, you're all at the finish line, so to speak, there's another really crazy thing that you can do with 529 money, and that is that you can take the money in the plan and put it into your kids' Roth IRAs for them. You can do this for up to 5 years of contributions, and remember the contribution limit is $7,000 per year, so it's basically up to $35,000 per child that you can do this for. Now, normally Roth IRA contributions have to be earned income. Your kids, when they're going through school, probably don't have much earned income, and right after school, the income from their job is probably more important to them than saving for their retirement. So I cannot stress enough how killer of a deal this is. If you set up a 529 for a kid when they're born, that's 65 years pretty much of tax-free compounded growth for them. So some people will intentionally overfund their 529 plans to take advantage of this. And by overfund, I don't mean beyond the legal limit. I mean they will put more than they think their kids will need for school, for the express purpose of planning to use the leftover funds to contribute to their kids' Roth. A killer strategy. Now, speaking of Roth IRA Magic, here's another really interesting strategy. Remember how I said that money in the kids' names counts more towards FAFSA eligibility? Money in your name still counts, but to a lesser extent. But money in your name in your retirement accounts does not count at all. So a lot of people will put money into their Roth IRAs, which you should be doing anyway, but as long as it's been in there for at least 5 years, you can pull out the principal, meaning the money that you put in, right? If you put in $7,000, you can take out that $7,000 after 5 years, but no more, no earnings or interest or anything, but still. So a lot of people will make a point to max out their Roth contribution every single year with the plan that once their kids are ready to go to school, they can apply for FAFSA, exclude this money from their net worth calculations because it's retirement money, not, regular money, and then pull out the principal and use it to pay for education without any additional tax consequences. So you get a double whammy benefit there. Traditional or pre-tax IRAs also can be used for some clever education planning. You'll recall that contributions to the IRAs are tax deductible. The money grows tax deferred, and as long as you make a qualified transfer from your IRA directly to the university, you will not have to pay income tax on that money. You can use it without having to pay tax on it. Remember that normally when you take money out of an IRA, you're taxed as if that was income from a job, which is pretty steep tax rates. However, there is an exemption where if you direct your IRA custodian, say Fidelity, to make the payment directly to the university, that money never touches your hands, and so you're not taxed on it. So you can get benefits on both sides. Remember, put the money in, get a tax benefit, let it grow, tax benefit, and then take it out without having to pay the tax. Again, as long as it's directly from your custodian to the institution. This also has the same benefit that the Roth IRA strategy does, where money in your retirement accounts is not counted towards FAFSA eligibility. Now, to wrap this video up, I'm going to go through a couple rapid-fire items that are not worth talking about at length, but I just want to at least bring up or touch on. And the first is a Coverdell ESA account. These are very similar to 529 plans. They're a little bit more restrictive, in my opinion, on how you can use the money, but they're good for people that want to go through private school or K-12 education or families with special needs children. There are some clever life insurance plans that can be devised using whole or universal life insurance to plan for your education. However, these are a lot more fine touch and you need a clever planner to help you with them, so I'm not going to cover them in this video. Remember that FAFSA is needs-based, not necessarily income-based. So even if you're a strong earner, you can still qualify for FAFSA for your kids, again, as long as you make some prudent planning steps to try to keep your net worth in the proper spots, let's say. And last thing, don't ignore other scholarship opportunities. It is crazy the amount of scholarship money that is pledged by charities, institutions, even the government. And this may come as a shock to you, but there's a website called scholarships.com which can help you find tons of scholarship money. I see articles all the time about students that were very on the ball with finding scholarships and they were able to find, hundreds of thousands of dollars of scholarships, often far in excess of their education costs. So keep in mind that no matter how good your education savings plan is, you'll also want to do as much as you can to reduce the cost of college itself, and scholarships are a great way to do that. Grandparents, I can almost guarantee you that your grandkids would rather have $20,000 worth of help with their college tuition while you are alive than to receive double that amount when you die. I always encourage people, please, if you're going to give people money anyway, do it while you're alive so that you can see the joy that comes, so that you can experience the gratitude from your grandchildren while you are here. That means so much more than to receive more money once you're gone. I said last thing, but here's the real last thing. Don't forget about the Lifetime Learning Tax Credit and the American Opportunity Tax Credit. To be eligible for either of these, you're going to need to be able to claim your child as a dependent. So if you're working with a blended family or if you've split from your co-parent, make sure that you guys are deciding amongst yourselves. The IRS lets you do that. You can determine between yourselves who's going to claim your child in what tax year as dependent. So make sure you're taking advantage of that and staying on the same page. If you find your head spinning with all the different investment accounts and tax strategies available to you, give us a call here at Centennial Advisors. We're always happy to point good people in the right direction. We specialize in retirement planning, but a big part of retirement planning is making sure that you are living your most fulfilled life. And for a lot of people, gifting education expenses, gifting education savings to kids and grandkids is a big part of that. On behalf of everybody here at Centennial Advisors, we hope you have a wonderful day.